Hey everybody, this is Jim at SP500chart.com. It is a little bit before 5 o'clock on February 4th, 2013. Before we look at the chart, I need to remind you that the website and the video are for educational purposes only, and nothing stated at the site or in the video is intended to be used as investment advice. I control lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. I'm not a licensed financial professional, just a guy that draws lines on charts. Okay, today we have, a little earlier than I thought, now the first sign that this nice uptrend from the gap up at the beginning of the year is in jeopardy. And I say this for a couple of reasons. The first reason is even though it is not a huge margin, we'll take a look at what the margin is here in just a second. But we are underneath this rising support line. And in fairly, what appears to be by the nature of the move, fairly convincing fashion, but we'll take a look at it. It's not at the threshold of being really, really super technically significant, but we need to call it what it looks like until it maybe shows us very soon that it's something else. But right now, I'm thinking that that this uptrend, I don't want to say it's absolutely busted. The reason I'm not going to say that is because the degree of the break of this line is not extreme. It's not. I mean, it's less than 1%, but we still have to consider it, and that's really this could call today the warning shot across the bow. The other reason I'm saying this is simply the levels that we were approaching. Now, I thought that the S&P would have enough steam in it to get up into the early, low 1520s, and there we have a long-term resistance line that seemed kind of ripe to be tested. Now, it is possible, and I'm not making a call on this, but it is possible that the S&P could find some support and then come up and back test this line a number of days down the road and hit that 1520, low 1520s mark. That is a possibility. So I'm not ruling that out. But I do want to show you where we have some support lines along the way here and where I think we could get a bounce, assuming that the S&P is unable to recover and get back into this channel very, very early on tomorrow or extremely early on Wednesday. But for now, this looks like a busted channel. But again, with the small caveat that it is not broken by a lot. So I think we could get a little bounce here on this rising line that provided support back here in the latter part of the year, mid-November through the later part of December. You can see that was violated the last week of December before that big gap up. So really, if we look at this, you could say, well, if we extend this kind of bluish colored channel back a ways, it looks like this has been a long-term channel that has had a propensity every now and then to dip below for anywhere from 2.5 to 3 days to a week. So let's keep our eye on this line, see if that gives us some support or provides some kind of bounce. Then we have this black line right here that represents the new high that was set by the S&P when it got over roughly 1472. And you can see that this line was defined by the top of this triple top back here, um, that took place later in 2012, and this pattern lasted a number of weeks, roughly 5 weeks. So since that used to be pretty strong resistance, we may see support kick in there. Now, if the wheels really come off, then we start having some even longer term lines. For example, we've got our rising teal line down here that could be a good candidate for a bounce. If that were to give way, then we have some horizontal lines that are either extended necklines from previous patterns or what we thought were going to be necklines from inverted head and shoulders that patterns that seemed to break out prematurely. Finally, if we go to a daily chart, we've got some very likely support about 100 points underneath us, a little less than 100 points, well, more than 100 points underneath us as of today, but both this line and this line are rising. Now, if we take a look at these to see where these lines get their genesis, this one is pretty long term. This is drawn from the 3.9 low of 2009 and the 10.3 low of 2011. And if that were to break, then I would think that that the markets would be in some pretty deep weeds, and likely could very well likely be setting up a test of this blue line. That if that happens, and if that were to break, then it would get really, really ugly. Well, it'd get ugly before there, but if that were to break, we're talking about really confirmed bear market territory if this were to break. The reason I say that is defining bear market as a 20% loss off of highs. Let's call it 1500 and 1200. If that were to break, then we're in bear market territory. Now, I've mentioned over the weekend and weekly review over this past weekend that this run from 3909 has been tremendous. It has been just under 4 years in duration, and I think you have to know the averages. The average bull market in the modern era post World War II, if my memory serves me correctly, runs a little less than 4 years. I think it runs about 3.5 years. As I recall, I believe it's about 42 months. I'm going by memory. It's either 42. It's less than 4 years. The average bear market runs about 18 months. So let's just see what happens going forward. Let me readjust my chart. There we go. You can see that the market, the S&P, moved very aggressively off of those 2009 lows, came up to over 1200, then came up to the high mid 1300s, and then a little higher, and then a little higher, and now a little higher. You can see what I'm saying is that if this were just if we weren't starting to lose some steam, then we should be doing a little better than what we are right now. But I think, quite frankly, it looks like the markets are starting to lose some steam. Additionally, let's go back to, I believe, a 1-day chart. If we draw a line on the October 2011 lows and get it right about at the early June lows, late May, early June lows, you can also see that this line tried to hold the markets up back in late October and early November, then it broke down. One might make the case in retrospect that what we've seen as this rally off of those November lows and then off of the January gap up, that all of this is something of a back test from this broken blue line. We have toyed with the idea of getting over this line. You can see just a little bit, but you can also see that depending upon exactly where we start this line, there's a little room for error here. So again, I would if we do rally and get back either into this channel, the red channel, or if we come down a little bit more, then do a back test, I would expect this brown line to be resistance. And if we just start falling from this point, then I'm looking for a potential bounce here. I don't think it would necessarily be long term, but I would think a stronger show of support around the 1470s, wherever that might occur, or this rising teal line right here. So guys, you know, probably the best thing to do, instead of trying to guess where the market is going to go, is if this is now a bona fide for real downtrend, just as we saw back in December, we set up a channel. The sell-off took place in a fairly well-defined little channel, and we looked for a break over that channel to signify that selling was over. So whatever transpires over the next week or two, likely we will. Okay, sorry about that. My wife just walked into my office for a second. We had to talk about something. What do I say? What I was saying is, hopefully, and more than likely, whatever we see develop over the next week and a half, week and a half, 2 weeks, if this is met with some follow through selling, and we don't get a bounce here, more than likely we will see something develop that will give us a clue as to when this potential down leg that I think we may have just kicked off here, we would get some kind of inclination as to when this would reverse and the market should start to head up again. Now, I talked earlier about the degree of the break. And this is important because we are currently just a little bit more 1504 and change, 1495 and change. We are about 2/3% underneath this line right here. But what makes me think that this likely is a legitimate downtrend is the fact that we kind of hung around this for a while, then it busted through, tried to recover, and then this little pattern right here looks like it may be sort of a flag-ish, kind of a little bit of a bear flag going on. So, that this just to me looks like we should get some follow through selling tomorrow. But I'll be honest with you guys, I have been on these little tiny calls, these calls on a 5-minute chart. The market has been surprising me a good bit lately. So I'm not really putting that in stone. All I would say is if we get more follow through selling, then that solidifies the legitimacy of calling this rising support line clearly broken by a technically significant margin. And at that point, we'll know more on what to expect going forward. Right now, there is a chance that we could recover. And if we did, I would still think this is a sign of weakness. But just the same, there is a chance. I don't think it's a great chance, but there's been surprises. So, guys, there you have it. That's the video for February 4th, 2013. This is a shot across the bow with today's close roughly 0.2% underneath our support line that had been holding the market up since January 2nd of 2013. Let's watch that really closely tomorrow. If we get more follow through selling and then a rally up to test that line as a back test by the textbook, that's where you make your decisions on getting out of long commitments or going short. So, but I'm not going to tell you what to do there. That's just the propensity. That's just what the markets tend to do. Back test, and then we get another down leg. So, guys, thanks again for watching. Take care.